Tamarack investors, hello. We're here today to talk about the impact of volatility on overall performance of an investment portfolio. And a lot of times when we're looking at how we expect or forecast an investment to perform, we typically look at what's the average return without really thinking about what is the volatility or risk profile of that investment. And when you measure volatility, we generally look at what's called the standard deviation from the average return. And you can imagine an investment profile that has maybe an 8% average return. One year it's 7%, one year it's 9%, the other year it's 8%. That's a very low volatility and therefore low risk. We look at things like debt or US Treasuries as these types of volatility profiles. Whereas when we look at the S&P 500, it's historically also averaged a return of 8%. But there's a lot more swings than what we see from year to year or month to month. I think a perfect example of that has been the first half of 2025, and we had about an 18-20% drop in the market from peak to trough. And while it's recovered, that has a substantial impact on both investor stress and psyche, as well as what performances are if you either buy or sell during that volatile period. And when we look at the S&P 500 historically, it has a volatility index of about 19%, and that is a standard deviation calculation. The point being is the higher the number there, the higher the volatility and therefore investment risk, and also the higher impact on its returns. And so what I did here is I modeled out a 20-year hold period that mimics a pretty standard S&P performance. And you can see here that the average return is 8% and the volatility matches the historical S&P of 19%. So what we can do is we can look at if an investor put in $100,000, how do we expect that to grow over time, assuming that all distributions are reinvested back into the S&P 500? And I think this should not come as a surprise. If you come off a couple good years, you're going to see portfolio growth, maybe some correction years, and over time the portfolio is going to grow, but it's going to have its ups and downs. And under this model, we see a value in year 20 of about $327,000. And what's important to know here too is that the higher the volatility, the higher the reduction in this end value is going to be. And we can compare that to a very simple model. If that same $100,000 achieved that same average 8% return, but there was zero volatility in it. That means that there's no down years, there's no amazing years, but it's a very tight and predictable return that grows steadily over time with a year 20 value of 466,000. And this is because of the fact that if you have a 10% drop in an investment value, you don't just, if you get a 10% return the following period, you're not going to be back at zero. You're going to be something like 98%. And so because of this, the average returns don't necessarily tell the whole story about what your performance is going to be on that. And this is one of the reasons why we're extremely excited about the private credit fund, where it's designed to both have a bit higher average returns than the S&P 500. We're looking about 10 to 12%, but it's also designed to be much more stable with less volatility in there. And so what's fun for me to look at too is if we have a steady 11% return on that, we can also see the impact of both slightly higher than average returns than the S&P 500, but also much lower volatility. And the result of that is that same $100,000 investment with the volatility of the 500,000, or the S&P 500 gets to $330,000, whereas with a very low volatility and slightly higher return, you can see that going to $806,000 after 20 years. These are the types of principles that we look at when we're making investment decisions, and just wanted to share this little case study on how volatility can impact investor returns. Thanks for joining.